Okay. Hello, my dear friends. This is CH Chinmay Hegde, your learning partner for understanding corporate accounting and financial management. Um, so today we are going to solve a recent examination question on this paper. Before we start, couple of things from my side. The most important element is which question you solve first in examination. Because quite often I come across students telling the time is not sufficient in examination. You always lack time, question paper is lengthy and so on. The answer to that question is please start from the question you know first and then next best and so on, so that the question which you don't know always comes towards the end, and the situation of the question you know it but you're not able to solve it will not arise. Let's begin by reading the question paper and solving the problem. And one more small hack technique also I'll tell you. So what you see, and you know that we have corporate accounting and financial management. Corporate accounting is for 60 marks and financial management is for 40 marks. One small trick I can tell you, when you read the question, right, read the requirement first. So then if you read the question, you know what that you are actually trying to solve. If I give a small example, if I ask you today, how many red cars you have seen? You will not be able to tell now because you don't know that I would ask this question to you. If I ask this question to you earlier in the morning and say I will ask this in the evening, you would have counted how many red cars are there. So you always get what you search for. So first in the exam question, you read what is the requirement so that you understand what is the requirement, what is the purpose of the question. Then when you read the details, you'll be able to connect it better. So like that, you can save time in examination. Anyway, let's go ahead. Question number 1, pass the entries. Assuming bank balance, you have to prepare bank account. And what are the restrictions on security premium? That seems like a theory question. So when you solve a problem in examination, first thing, when you try to read the question, try to understand which chapter and which concept it is related to. That's why I also tell in the class, the classroom is like a film theater, because you sit and enjoy somebody else's performance. In film also, you just enjoy somebody else on the screen. In class, the faculty will solve the problem and you just copy it down. You are not under a pressure to solve. But examination is not film theater, it is operation theater. Because anesthesia is on, called as question paper. And after 2 months, 3 months, result comes, operation success, patient died. You knew the problem, but you could not solve it. But anyway, let's not spend too much of time. Let's go ahead and solve the problem now. Let us read this question. Technocrats Limited invited applications for 1 lakh equity shares of 30 each. The shares were issued at a premium of 15 per share, payable as follows. On application and allotment, rupees 24 per share, including premium of rupees 9. On first call and final call, balance including remaining premium. So this problem is regarding share capital, issue of shares. Applications for 1,50,000 shares were received and applicants of 10,000 shares were rejected on allotment, and on pro rata allotment was made for remaining applicants as follows. Applicants for 80,000 shares were allotted 60,000 shares. Applicants for 60,000 shares were allotted 40,000 shares. So there is an oversubscription in this case because they have invited for 1 lakh, but they have received 1,50,000 shares. Applications, oversubscription, so they have to do a rejection or a pro rata allotment. They have done both. So 1,50,000 they have received, 50,000 they have outrightly rejected. So balance 1,40,000. For balance 1,40,000 they did pro rata allotment, proportionate allotments. In the sense, for 80,000 shares who have applied, 60,000 is allotted, and for 60,000 shares, 40,000 is allotted. So 60 plus 40, 1 lakh is what the shares are issued for, and 80, 60, 110, that will come to 1,50,000, which is the application part. Mr. X, who belongs to A category, means this application 80, 60, was allotted 300 shares. He failed to pay the call money. Mr. Y, who belonged to B category, applied for 300 shares, also failed to pay the call money. So when they fail to pay the call money, most probably, of course, there will be calls in arrears, and because of this failure, the company will do something called as forfeiture of shares, meaning cancellation of shares. So whatever the money received, we will not be giving back, and then that shares will be reissued to somebody else, and thereby company able to get extra money. These shares were forfeited and reissued at 36 per share. Assume that excess received application is to be adjusted towards share capital account first. You're required to pass the entries and something else they have given. So in this problem, there is quite a amount of breakup of how much is I would call it as face value and how much is the premium amount. So I would like to do some calculations regarding that first. So in this question, let me see. The issue price is 30 and at a premium of 15. So total issue price is 30 plus 15, right? 30 plus 15, total issue price is 45 rupees, where 30 rupee is on face value, and face value means when you pass the journal entry, that will go to share capital account, face value 30, and as premium means it will go to security premium accounts. So security premium, and that is 15. And I hope you are able to see what I am writing. Then similarly, this is with respect to what is happening at overall level, but they are happening two installments, in the sense first on application and then on first and final call. So let me write first on application and then on call money. In each of these two cases, there is a breakup of a face value and there is a securities premium. Let me calculate how much of this. Face value and security premium. Let me read it. This question is actually a little tricky and lengthy. So among all the questions, this I am going to take a little bit extra time. So please bear with me. So if you can understand this question, you can solve any problem related to the share capital reissue. Very nicely drafted, a complicated question. And that's the institute strategy, I would say. By asking the complicated question in the first one, it's like first ball bouncer in cricket match, and student will lose confidence and they will not do well in the remaining questions. Only this question is having little bit of complications, so please bear with me. And you people, if you can solve this problem, this entire forfeiture concept becomes easy for you. So use this as a good base for revision of this concept. Okay. Now going back, issue 24 including premium of 9. So application allotment is 24 rupees including premium of 9. If premium is 9, a face value should be 24 minus 9, which is 15 rupees. At 24 rupees second. What is happening? Yeah, great. Similarly, call now. 45 was the issue price. Application money we had received 22. Remaining 45 minus 22, that will be 23 rupees. Sorry, 24, right? I'm sorry. 24. So 45 minus 24 is 21 rupee. I'm sorry, I've corrected it. Now, how much is premium? Balance including the remaining premium. Okay, so premium amount was 15 rupees. If 9 came in application, remaining 15 minus 9, 6 will come from call money. Face value therefore 21 minus 6, and that is 15. So for more clarity, I will give you this calculation. Face value, how much is coming from application money and during application, and how much coming from call stage. So 15 came from application stage. So balance 15 came from call. Security premium during application, it is 9 rupees. So remaining during call, we got 6. So that is the complete breakup. So I hope you are able to calculate it. So any doubts until so far? Because this is a fundamental calculation you should understand. I hope it is fine. Now let me just give you an overview of the journal entries that is going to be passed, and accordingly we will look at the calculations part of it. First, you receive the money. Therefore, the journal entry will be bank account, money is coming in, debit the receiver, bank account to share application and allotment account. That is for share application money received. Then you allot. So share application to share capital. In this problem, the share application also receive premium. So share application to share capital to security premium. Did you get the point? Share application allotment to share capital to security premium. Face value go to share capital. How much face value? In the application stage, 15 rupees goes to share capital, 9 rupees will go to security premium. That is the second entry. Then for call money due. Okay, before call money, there is a refund of 20,000. Okay, that also let me calculate with respect to the number of shares applied, application. How many shares have been received? Number of shares is 1,50,000, right? Applications for 1,50,000 was received. And in 1,50,000, three kinds of treatment can happen. One is you will do full rejection. Outright, you will not issue any shares, entire money will be refunded. Then full allotment. So how many ever shares are applied, entire money will be allotted. And then pro rata allotment. In this problem, they said 10,000 full rejection, full allotment nothing. So balance is pro rata allotment 1,40,000, and there are two categories: those who applied 80,000 shares and those who applied 60,000 shares, right? 80 and 60. And 80 you have allotted 60,000, and 60 you allotted 40,000. So if I just show the calculation little bit downwards, I hope these things are visible. So on 80,000, how much is being allotted is 60,000, and how much is being adjusted? They were supposed to be refunded, right? Out of 80,000 applied, only 60,000 is allotted. So balance 20,000 was supposed to be refunded, but that money is not refunded. That money is adjusted towards the next call money. Similarly, on 60,000, something is allotted and remaining is adjusted. So remember, of 60,000, 40,000 is allotted and remaining 20,000 is adjusted. So if you know this much of calculation, journal entry also is easy, calculations part also is easy. Only thing we should be careful about the calls in arrears and all, but that anyway, institute has given the calculations, but somehow in the answer they have not given this clarity of how the issue price is calculated, application money is broken into face value premium, and call money is broken into face value premium, which is not given the institute solution in detail. So I've given you for your reference. I hope you're able to appreciate it. Yes, this is only for new syllabus students. Yes, my dear friends, this question paper is only new syllabus, so it is relevant only for new syllabus students. For old syllabus, as a conceptual ones, you can follow because a lot of common topics are there, but the problem I'm solving is new syllabus. Okay, great. So now I'll go back to the institute question and I'll go through the solution and explain the calculation how it comes. So first, journal entry, as I told you, bank account debits, that is a money is received to share application allotment account. How much money is received? You are receiving money on, you see my calculation, money is received towards 1,50,000 shares. And how much application money? 24 rupees. So 1,50,000 into 24. So that's what is 36 lakhs. So amount received, bank account debit, to share application allotment 36 lakh. So first calculation is completed. Now once you receive the money, what will you do? You will distribute. Either you will allot or you will repay. If it is allotted, face value goes to share capital. The excess money goes to security premium. If it is repaid, you will say to bank. So they have allotted for how many shares? Allotment is done for 1 lakh shares, right? That is 60,000 allotted, 40,000 allotted. So 1 lakh shares, 1 lakh shares multiplied by how much face value? In the application, you can see here 15 rupees. So here 1 lakh into 15 rupees. Then how much goes to security premium? Again 1 lakh shares, security premium is 9 rupees. So 1 lakh multiplied by 9 rupees. Face value allotment to share capital, excess money premium amount to security premium, and what is repaid? Outright rejection, that is 10,000, right? So 10,000 and the amount money is received for every share was 24. So this is the second entry. I hope you're able to follow. Now coming to the third entry for call money due, money to be received. So share first and final call account on 1 lakh shares multiplied by how much is the call money? Total 24 was application and 21 is call. So 1 lakh into 21, 21 lakh. Share final call. The face value will go to share capital. The excess money will go to security premium. So 1 lakh multiplied by 15 rupees going to share capital, 1 lakh multiplied by 6 rupees going to security premium, 15 and 6, that is the breakup in the call money towards face value and security premium. I hope you're able to follow this third journal entry as well. Now I'll go towards the next call money received. This is where the complications arise, so please pay attention. How much money received is quite a few things are there because call money was supposed to be received, and from that money two kind of adjustments will be made. One, what was supposed to be received is already received towards pro rata adjustment. So that money we will not receive, it is already adjusted. The balance money from two sets of people, what we are supposed to receive, we did not receive, so that money will be reduced. So in that sense, let us calculate how much is calls in arrears. Let us read belonging to that one, and again they are playing with the words and playing with our feelings here. First one is Mr. Y belonged to A category who was allotted 300 shares, and Mr. Y who belonged to B category who applied for 300 shares. So one person allotted, other person applied. So read the sentence carefully. Examination is operation theater, not film theater. So regarding that adjustments, just give me 1 second. So I just want to add few pages here. Okay. Okay, fine. So let me do it here. Okay, great. So here, relating to those two people, that is the partial allotment, right? The categories people. So I'll just call something like, special allotment. For those two people alone, I'll calculate, okay? Mr. X and Mr. Y. They have applied for certain number of shares and they were allotted few shares and they were adjusted few more shares. So that you have to understand. So Mr. X who applied for and the ratio, please understand, the ratio is 80 if you allot, 80 is you apply, 60 is you allot. So category A, X is what is applicable for category A. So for Mr. X belong to a category allotted 300 shares. So Mr. X allotted 300 share, Mr. Y applied for 300 shares. Okay, so how much is have been applied for, how much has been adjusted for? Look at the ratio calculation. If you allot 60,000, that means you must have applied for 80,000. So that is the ratio here will be, the ratio is if you allot, if you apply 80,000, 60,000 is allotted. If you allot 300, how much is applied? This is for Mr. X. Similarly for Mr. Y, the ratio is if you apply 60,000, you will get 40,000 and Mr. Y applied for 300. So how much is allotted? So cross multiplication if I do, 80,000 into 300 by 60,000, that is 400. He has applied. 100 is allotted. So remaining 100, 300 is allotted, 100 is adjusted. Similarly, if I cross multiply here, 300 into 40,000 divided by 60,000, and that is 200. So out of 300 applied, 200 is allotted, 100 is adjusted. And therefore, number of shares on which the call money due, I think that we were discussing, that we discussed. How much money received, we were calculating that. So on these two people, 500 shares is where these people were allotted, but the call money they did not pay. Call money they did not pay, and some money was adjusted. So how much money is adjusted? That is what they have done the calculation. see on 400 rupees, 400 shares or 300, 200 each, they have paid 45 rupees issue price that we received, and 24 rupees that is not received, but some amount is adjusted. Let me show the calculation. Let's see if we're able to understand. On Mr. X shares, 300 share is the one which is allotted. What is 300? That is the allotment now. 300. Money due. Call money 21. So 300 into 21. 6,300 was call money due. Out of 6,300, some money already received. How much money? 24 rupees the application money on 100 shares. So 100 into 24. So out of 6,300, 2,400 already received. So 3,900 money not collected, called as call-in-arrears. Similarly for Mr. Y, he has allotted 200 shares. On 200, we are supposed to receive 21 rupees. So 200 into 21, 4,200, which we did not receive. A portion of which is already adjusted. How many shares? 100 shares. How much? Into 24 rupees. So out of 4,200, 2,400 was already received. As a result, the balance call-in-arrears is 1,800. So from Mr. X, 3,900 is call-in-arrears. From Mr. Y, 1,800 is call-in-arrears. 3,900 plus 1,800. So total 5,700 is call-in-arrears, which represent money not received. Why are we calculating this? Out of the call money received, some money already adjusted as pro rata allotment and some money not received. The balancing figure must be the money receivable. It can be calculated in many ways. I'm just going with whatever institute has suggested. So what was the application money due? We have money due is total 21 lakh. 1 lakh into 21, total 21 lakh, 1 lakh into 21. Then some money was adjusted. How much money? Adjusted. Here we have calculated, right? 20,000 shares, 20,000 shares. So 40,000 shares multiplied by call money, application money of 24. So 40,000 into 24 is 9,60,000. So out of 21 lakh, 9,60,000 already received during application, and the 5,700, that is 3,900, 1,800 is not received. So balance 11,34,300 is received. So the journal entry 11,34,400 money received, that is bank account debit. Then share application and allotment accounts. That is 9,60,000. What I just told, it was supposed to be bank account debit. Instead of bank account, we are debiting share application and allotment account debit. Then 2, share final call, the net amounts. Remaining 3 entries are there. That is very small. That is relating to call-in-arrears and then reissue and transferring it to capital reserve. That will not be a complicated one. So before I go further, any calculations? You want any clarification? Okay. I have no questions coming in, so I'll go further. I hope it is fine. Great. Now, with respect to forfeiture, the journal entry will be just a reversal. But in this problem, there is one peculiar thing which is being happening. And that is, forfeiture means what? Cancellation. So journal entry effectively so far is credited to share capital and credit to security premium. And now we have to reverse it. In the sense, the share capital will be debited, security premium will be debited, and whatever money received, that will be going to share forfeiture. Money not received will go to calls and arrears. Correct? Or calls and arrears or the share application allotment account. But in this case, security premium in application is received, but security premium in allotment is not received. So when it is not received, then that premium account will also be reversed. The security premium, which is part of allotment, money was not received, and therefore we have to reverse that part as well. Otherwise, security premium received will not be reversed. If you want, I'll just write one small chart for you so that you will remember it. Security premium received and not yet received. If it is not yet received, then it will be debited during forfeiture. If it is already received, it has gone to security premium, then there is no question of any reversal. So this is not applied, not considered during forfeiture. Okay, so now coming to the calculation part. Yeah. So how much is the how many shares who have been forfeited as per our calculation? 300 plus 200, 500 shares. And what is the issue face value? Face value is 30 rupees, right, per share. So 500 shares into 30 rupees. So 500 shares into 30 rupees is the share capital credited. On forfeiture, it will be debited, and thereby that is being closed. Then share and final call 5,700. This is calls in arrears, which we have calculated. Then security premium on 500 shares, the security premium not received, that is as part of call money. As part of call money is 6 rupees, right? 6 rupees. This is where it is not received. And they also said in the question, money received is first adjusted against face value and then goes to security premium. So on 6 rupees, money is not received. So 500 into 6, 3,000. Security premium is debited, and share forfeiture balancing figure, basically this represents money received. That will go to share forfeiture. Then the issued are 36 rupees each. So 500 shares multiplied by 36, reissue. So 500 into 36, that is 18,000, and the face value is 30 rupees. So 500 into 30 rupees, that will go to share capital account, and premium balance 6 rupees, 500 into 6, that will go to security premium 3,000. And whatever is the share forfeiture account, upon reissue, the share forfeiture account has no relevance, that will be transferred to capital reserve. So there ends the journal entries part of it. The complicated issues, what you need to keep it in mind is this breakup of calculations. How much is relevant, how much in issue price, face value security premium, how much in call money, face value security premium, the number of shares applied, how much is allotted, how much is rejected, and how much is adjusted. This chart should give you the clarity on all the calculations. Then we have formality of looking at few more points. Please let me know if you have any doubts. I think I have no questions coming in, so I am going for the next part of the question. Assuming opening balance of 1,25,000, prepare the bank account. Okay, let me show the bank account. Not take much time. Bank account opening balance, they said 1,25,000. Money received, journal entry also be passed. bank to share application, when money is receiving, it is debited, debit the receiver. So to share application and allotment, call money received to share first and final call. Then when you reissue, right, you have reissued upon forfeiture, you receive 36 rupees into 500, that money also will be debited. Then you have refunding on some 10,000 shares. So on refunding, journal entry also we did the share application allotment account to bank account. So that money balancing figure. So this is your bank account. This is not complicated in my opinion. Then coming to the next part of the question, what are the restrictions on security premium account? As per Companies Act, security premium is not a free reserve, is not a profit earned, so it can't be used for payment of dividends. It has certain limited restrictions. It can be used for bonus shares issue. It can be used for writing of preliminary expenses, writing of commission or discount on issue of debentures or shares, or premium payable on preference shares, and also buyback of shares. Security premium can be utilized. I would say 4 plus 1, because these 4 are covered in one section and 68 specifically covers regarding buyback of securities. So 4 plus 1, only 5 purposes for which security premium can be made use of. So this is not also uh, a complicated one. So this is a theory one. I've covered the important point. So the first question is completed. The first question, as I told you, this is a lengthy one, and it will take more time. Complications were there, I really understand. But if you can solve this kind of complicated problems, you'll be able to revise the concepts better and perform well in examinations. Good roads will not make good drivers. Easy questions will not make good professional. Professional means you have to solve bigger problem in life. So don't get afraid of any kind of questions in examination. Of course, all questions you may not be able to solve, but never shy away from giving your effort. So when you solve a difficult questions, you will get more confidence. The confidence will not come by solving easy questions. Solving these kind of questions only will make you a better professional ready for your career. But anyway, solving these kind of questions will give you good confidence for the as a base for any questions coming out of this variety. I hope this this discussion was useful. I'll go further towards the next question. Okay. Question number 2. Following is the summarized statement of profit and loss, balance sheet provided. They have given sales, other income. Okay. Sales, other income, cost of sales, gross margin, excluding other income, operating expense, selling and distribution expense, profit before interest and tax, interest, provision for tax, profit after tax, balance sheet. Fixed assets, current liability, net current assets, total assets, liabilities, other equity, share capital, surplus, long-term debt. Great. Then they're asking current ratio. What is the formula for current ratio? Current assets divided by current liabilities. So current assets means they only have given heading current assets, inventory, account receivable, cash and bank. 16.64 plus 15.43 plus 1.75. So current ratio is current assets divided by current liability. So 16.64 plus 15.53 plus 1.75 divided by current liability. Current liability is 11.25. So you get 16.64 plus 15.53 plus 1.75 by 11.25, 3.01. Let us look at the insert solution faster so that we can save time. Okay, so yes, 3.01, 16.64, that is inventory, account receivable, cash, divided by current liabilities. Current assets divided by current liability, that is called as current ratio. Current assets means receivables, current liability means payables. So short-term receivable, short-term payable, short-term liquidity, the short-term solvency of the organization is measured in current ratio. So first one is done. Liquid ratio. Liquid ratio means it's similar to current ratio. The difference is we have to take care of inventory. Inventory is not considered in liquid ratio, also called as acid test ratio, also called as quick ratio. So don't take the inventory part out. The inventory part is 16.64, don't take that. Remaining 15.43, 1.75. 15.43, 1.75 by 11.25. So current ratio is done, liquid ratio is done. Then coming to gross profit margin ratio, gross profit by sales into 100. So gross profit, question only has 33.98. It should exclude other income. They have excluded. So they only have helping us. Gross margin by sales into 100. Gross margin 33.98. Sale is 144. So 33.98 by 144 into 100. Then we have next requirement, net profit. Net profit by sales into 100. Profit after tax. The profit after tax is net profit. So 15.78 by 144. Net profit is profit after tax divided by sales into 100. Net profit 15.78 divided by sales 144 to express in percentage multiplied by 100. Last one, return on equity. Return means net profit, that is profit after tax. Equity means shareholders' funds. Share capital plus reserves surplus. Share capital 27 plus reserve 6.36. Don't add profit. Reserves includes profit. So share capital 27 plus 6.36 will be in the denominator. So that is what, 27 and 6.36 is 33. Share capital plus reserves and surplus is your equity. Numerator is net profit 15.78. So this also easy question. 5 simple ratios, and I hope you are able to solve it. Next, the following balances appeared in the books of the company on 1st of April 2022. Sinking fund for redemption of debentures, sinking fund investment 3,44,425, 7% debentures. In order to redeem the debenture, company sold the investments and realized 3,45,000. You are required to pass journal entry, the accounting treatment for profit or loss on sale of investment. This is what I tell you, my dear friends. If it is easy question, I mean, some people miss out certain questions, right? In the sense they skip chapters. You can skip chapters because I understand you have time limitation, understanding limitation, constraints are there. You are not able to solve all the chapters. But I always say, don't skip any chapter. Do simple problem at least for 2 reasons. Reason number 1, if you want to leave the topic in the exam, you should know the question is from that topic. Otherwise, how do you identify which question is from which chapter if you don't have the chapter knowledge? You should know basics of it. Second, if easy question comes, you should not miss out, because if difficult question comes and you don't do it, you don't feel bad. But if easy question comes after the exam, you will feel bad for yourself. Yeah, easy question, I should have solved it. And one example of that is the question here. And that is this question. Because you are required to pass an entry for sale of investment. So by reading this question, many people misjudge. Oh, this is redemption of debenture, own debenture and all is there. I don't know how to do. I'll skip the chapter. Many people have asked me, sir, can I skip this debenture chapter? So, and if you skip this question, you lose easy 2 marks because this is nothing to do with debentures, redemption. They are selling investment. What is the journal entry for selling investment? Money is coming in, bank account debit, investment is going out. So bank account debit to investments. Profit or loss on sale, you count. If it is profit, to profit. If it is loss, debit loss. So in this case, book value is 3,44,000, sold for 3,45,000. It is sold at a profit. So only one entry you have to pass. So look at the entry. Debenture sinking fund investments account debit to debenture sinking fund account 675 profit. Actually, it will go to P&L account. Effectively, you have to pass an entry bank account debit 3,45,000 to investments, which is 3,44,325. Balancing figure profit on sale, that is 675, will go to P&L account. You have to pass this entry. And the sinking fund investments. Actually, they have not asked for redemption debenture. Okay, even if you think of redemption of debenture redemption is nothing but a repayment. So you have to pay the money to bank, and debit is debenture. So debenture to bank, or whatever the sinking fund you have, that amount is no longer required. You will transfer to general reserve. If they ask you redemption, then you say debenture account debit to bank. But they have not asked for the debenture entry. They have asked for sinking fund. Now sinking fund, 5,50,000. 5,50,000, right? Yeah, I think 5,50,000. Yeah, I think they have missed it. 5 lakh. The sinking fund is 5,50,000. That is no longer required. That will be transferred to P and the general reserve. That will become now free reserves. I think the amount is a mistake here. I think 5,50,000. I'm not sure whether the question paper mistake or the solution mistake. Oh, sorry, sir. They have given out of debenture outstanding on 1st of April 22 is second part of the question. Oh, sorry. This is next part of the question. I'm sorry. This 5 lakh is not relevant for this. They're not asked regarding 5,50,000, so you need not do anything. Okay. Second part of the question, out of 10 lakh 6% debenture outstanding, the rupees 5 lakh debentures were redeemed on 31st October. Okay. The balance of debenture sinking fund was 10 lakh. Interest debenture was 31st March. Okay. This is the next part of the question. Nothing to do with part A of the question. I'm sorry. Please ignore that point. This is second part of the question. Okay. So here you are redeeming 5 lakh. So 5 lakh debenture sinking fund no longer required. So 5 lakh it is transferred from sinking fund to general reserve. And interest is paid only till the time of redemption. So they repaid it on 31st of October. That is for a period of 7 months, right? So on 5 lakh from April to October, April, May, June, July, August, September, October. For 7 months, interest is paid. So 5 lakh at the rate of 6% into 7 by 12, interest is paid on 17,500. I hope this also is fine now. Okay, I'll go further. Y Limited recently reported following income statement: sales, operating cost, EBIT, interest, EBT, tax, profit after tax, dividend, retained earnings. This year, company is forecasting 25% increase in sales and expects this year end operating cost will be 70% of sales. It is expected that the tax rate, interest and dividend payout ratio will be constant. You are required to compute the projected net income and expected growth rate of dividend. In fact, a very similar question is there in the study material. Exact same question I would say, which I also solved in the class. Very simple, projected one. So what you are going to do, they said sales is 600, Forecasting 25% increase, 600 plus 25% is 750. And then operating cost will be 70%. So 750, 70%, and that is 525. So you get EBIT, 750 minus 525 is 225, minus interest. Interest will remain same, 40. So interest is remaining same, 40. So 225 minus 40, that is 185 is EBT. What about tax rate? Tax rate 40%. So 185 multiplied by 40%. That is the 74. So profit before tax minus tax. So what you get is profit after tax. Now from profit after tax, you distribute dividends. For distribution of dividends, they said the payout ratio will remain constant. Payout ratio means dividend divided by profits. So last year, they paid a dividend of 21.6 crores out of the profit of 54 crores. So how much will be there? So if whatever the dividend they distributed, divided by the profit after tax into 100, payout ratio. So 21.6 is dividend, 54 is the profit into 100. So 21.6 by 54 into 100, 40%. So the 40% remains same. So 40% of 111, 40% of 111, you get 44.4. So retained earning is 111 minus 44.4, 66.6. What about growth rate in dividend? Previous year dividend was 21.6. Now this became 44.4. How do you calculate the growth rate? Any growth rate, not only the dividend. Any growth rate is the current one minus the previous one divided by previous into 100. So the current one dividend is 44.4 minus previous, that's what they have done here. 44.4 minus 21.6 divided by 21.6 into 100. So that will tell you by how much the dividend has been increased in the current year as compared to previous year. So that is about question number 2. Okay, so do you have any questions in this one, or shall I go further to question number 3? Okay, so no questions are there. Great. Let's move further. Question number 3. Calculate the liability of individual underwriters. Underwriting problem. We start with the gross liability. We subtract marked applications, and then we subtract unmarked applications, or vice versa. Both answer ultimately is remaining same. So keep that in mind. XYZ incorporated on 1st of April a prospectus inviting applications for 5 lakh shares of 10 each. The whole issue was fully underwritten by KBDM as follows. KBDM. The application received for 4 lakh 50, of which marked applications were KDBDM. Calculate the liability of underwriters. So this is marked application. So how much is marked total? 2 lakh 20 plus 90 plus 1 lakh 10 plus 10. So 4 lakh 30,000. So out of 4 lakh 50,000, 4 lakh 30 is marked. So remaining unmarked is 20,000. Unmarked application will be divided in the gross liability ratio. So 2 lakh, 1 lakh 50, 150. If you divide by 50,000 each, I think 4, 3 to 1. Right? If you divide by 50,000 each. So in the ratio of 4:3:2:1, this unmarked applications will be allocated among all the underwriters. Okay, let's look at the solution. So gross liability, they only have given 2 lakh, 1 lakh 50, 1 lakh 50,000. So 2 lakh, 1 lakh 50, 1 lakh 50,000. Unmarked application, I just showed you 20,000 in the ratio of 4 is to 3 is to 2 is to 1. So 4, 3, 7, 7, 2, 9, 9, 1, 10. So 20,000 into 4 by 10 into 3 by 10 into 2 by 10 into 1 by 10. So you get 8,000. That's what you get, right? First one, 20,000 into 4 by 10. So you get 8,000 into 3 by 10. 6,000 into 2 by 10 and 1 by 10 in the ratio 4 is to 3 is to 2 is to 1. So unmarked application is done. So gross liability minus unmarked application. So 20 minus 8 is 2 lakh minus 8 is 1 lakh 92. 1 lakh 50 minus 6 is 1 lakh 44. 1 lakh minus 4 is 96. 50 minus 20, 48. Then you subtract marked application. Marked application given 2 lakh 20, 90, 1 lakh 10 and 10 as it is given. That also you subtract. Then what you get is remaining underwriter's liability. So 1 lakh 92 minus 2 lakh 20 minus 28. 1 lakh 44 minus 90, 54. 96 minus 110 minus 14. 48 minus 10, 38. The minus number represents surplus thing. So they have got more application. So when some people have got surplus, that will be distributed to others. Now 28 and 14. So surplus is 42,000 and the people who are facing the shortage is B and D. So B is having 1,50,000, D is having 50,000. So in the ratio of 3 is to 1, 1,50,000 and 50. So 42,000 in the ratio of 3 is to 1. So 42,000 into 3 by 4, 42,000 into 1 by 4. So that's what you get, 31,500 and 10,500. So you subtract 22,500 and 27,500, that becomes the liability for B and D. Just a quick verification. How much is the total? 22,500, 27,500, you get 50,000. And that should match up with total shares not subscribed. Take a look at this. Company issued 5 lakh. Subscribed is 4 lakh 50. So 5 lakh minus 4 lakh 50, the balance is 50,000. That's what this 50,000 ultimately to be borne by B and D, 22,500 and 27,500. Okay, great. Next. On 1st of April, the following balances were given. Preference shares, security premium, general reserve, P&L. The company redeemed the preference share at a premium of 5%, and for the purpose, it issued equity shares at a premium of 1 for such an amount as necessary for the purpose after utilizing the profits to the maximum possible extent. You require to pass the journal entries for the above mentioned transactions. Okay, so now when we talk about redemption of preference shares, there is a requirement of transfer to CRR. Logic part I hope you know, because when you redeem preference shares, you are violating the regular order of repayment. You are repaying the preference shares before you repaying the outsiders. So as a result, the Companies Act have put a condition stating if you are redeeming preference shares, the face value of redemption of preference shares must be replaced, substituted either by transfer to CRR from free reserves, or issue of equity shares, or any combination of both, issue of equity shares. Okay, now in this problem, security premium is not a free reserves. So we have a general reserve, we have P&L account. So general reserve is 1,60,000 and the P&L 1,18,540. Preference share face value 5 lakh. So 5 lakh is the preference shares. And what is transferred to free reserves? Security premium is not free reserves. So I have P&L and I have general reserve. Those two things are free reserves available for distribution of dividend, therefore free reserves. P&L 1,18,540. General reserve 1,60,000. So 1,18,540 plus 1,60,000, 2,78,540. Balance 5 lakh minus 2,78,540, that is 2,21,460. This is what is going to be issued by equity share face value, and the face value of equity shares is 10 rupees. So divided by 10, you are going to issue 22,146 shares. That is the number of shares that is to be issued. Let's look at journal entry. So as I just told you, 22,146 shares are issued. The journal entry will be money is coming in, bank account debit, 22,146 multiplied by 11 rupees, 10 rupee issue price and 1 rupee premium, 22,146 into 11, 2,43,606. Then 10 rupee face value goes to share capital, to equity share capital, 22,146 into 10 rupees. 1 rupee premium, that goes to security premium, 22,146 into 1 rupee, that will go to security premium. Okay, first entry is done. Then the security premium, you can use it for redemption preference share, but I would pass that entry later. I would pass these two entries later. Let me discuss this one first. Redemption of preference shares. Preference share face value is 5 lakh. Preference share capital will have a credit balance, and if you have to close it, that will be debited. So debit preference share capital 5 lakh. Premium is 5%. So preference share capital account debit 5 lakh. Premium on preference share 25,000 to preference shareholders. That is total liability. Then preference shareholders to bank 5,25,000. Preference share is done. This premium account need to be adjusted. So premium account, so amount is debited. This is debited. Now we have to be credited. So security premium account debit to premium or redemption. So this 25,000 is being adjusted. Then whatever I showed you, transferred to free reserve, P&L 1,18,540, general reserve 1,60,000. Those two things will be transferred to CRR accounts. So general reserve, P&L to capital redemption reserve. So that can be used only for the purpose of issue of bonus shares, so that you're redeeming the preference share now, share capital is reducing, but because of CRR, because of issue of bonus shares, capital will increase. As a result, the capital remains intact as far as the outsider is concerned. I hope this you are able to follow it. Let's go further. The summary balance sheet of ABC on 31st March 2023 as under share capital, security premium, P&L, debenture, trade payables, freehold property, stock receivable, cash, balance at bank. The annual general meeting of ABC, it was resolved that issue bonus shares for every 4 shares held. 1 bonus for every 4 shares held. So how many shares are there? Authorized capital, not important. Paid up capital, 20,000 shares. 20,000 shares, 1 for every 4 shares. You get 5,000 and 10 each. So 5,000 shares into 10. So face value of the bonus issued is 50,000 rupees. And to repay debentures at a premium of 3% means redemption of debenture, record the above journal entries. Okay, simpler one. Okay, bonus shares. Bonus shares means capitalization of reserves. Reserves will be transferred to share capital. Reserves, we have security premium can be used, and P&L also can be used. I need 50,000. So 30,000, I'll take it from security premium, balance 20,000, I'll take it from P&L. Because 30,000 security premium, balance 20,000 P&L, because total amount of bonus worth is 50,000. So security premium account will have a credit balance, P&L will have a credit balance. If you have to transfer means they will be debited, transfer to bonus, and bonus account to share capital. And you are redeeming debenture at premium. Debenture redemption is nothing but repayment of loan. Debit the debenture, credit the bank. Debenture to bank at a premium of 3%. So 1,20,000, 3% means 3,600. When the company pay premium, it is an expense. So you debit debenture, it's a liability getting closed. Debit the payment, it's an expense, premium payable, 3% of 1,20,000, 3,600, payment to bank. And this premium account, you will adjust in P&L account. Instead of directly to bank, they are writing debenture holders, then debenture holder to bank. A direct entry, you can also say to bank, that is also accepted from exam point of view. So this is regarding question number 3. So do you have any doubts in question number 3? Oh, great. Next question is consolidation problem. The question they have asked in such a way, that it is so much confusing. Actually, very simple problem. Let's read the question. I'll tell you the calculations. On 31st March 2023, H Limited has 20,000 shares out of 25,000 shares issued by S Limited. H Limited acquired these shares in the following manner: on 1st of April, 1st of October, 1st of Jan. There is one big googly in this question, because normally when we say 25%, it is 25% of subsidiary company shares. But please observe, 25, 37.5, 37.5, that comes to total 100%, right? But they have acquired only 20,000 out of 25,000. That comes to only 80%, 25 by 20, 20 by 25. So this 25%, this 37.5%, this 37.5% is not of subsidiary company shares. These percentage 25, 37.5, 37.5 is out of 80%, is out of 80%, is out of this 80%. That's what they have acquired, the shares. On 31st of March 22, the balance sheet of S Limited exhibit a share capital of 150 and reserve surplus 125. This is 31st March 22. Then during the year 22-23, net profit earned for the company is 50,000. It was distributed evenly throughout the year. And the amount of reserves and surplus on 31st March 23 stood at 1,75,000. Ascertain the share of parent company in profits of S Limited on different dates of acquisition. Meaning on each date, what is the profit that belongs to the holding company, you have to tell. Not a regular consolidation of goodwill calculation or any minority interest calculation, not like that. Institute has complicated the solution pattern. I don't want to complicate so much for 5 marks and all. I'll give an easy answer. You try to follow it. Maybe here only I can write. I'm sorry, I think I just got the question now. Once again, explain the part of bonus issue. Okay, I'll quickly explain before I come to this. Bonus issue means reserves transferring it to capital. So the journal entry of bonus will be reserves account debit to bonus, bonus to share capital. The reserves can be security premium. The reserves can be P&L. Any reserve is accepted. Capital reserve is also accepted as long as it is realized in cash. So reserves to bonus, bonus to equity shares. It is issued one for every bonus shares issued, one for every 4 shares or something like. Yeah, one for every 4 shares. So 2 lakh was the share capital into 1 by 5, that becomes 50,000. So 50,000, 30,000 coming from security premium, and then balance 20,000 I take it from P&L. So security premium account debit to P&L account debit to bonus, bonus to share capital. I hope the bonus part is fine. Just want to come back to this consolidation. I hope the bonus is clear. If you have any other doubt, you are free to ask. Okay, I am not getting any answer. I hope it's fine with you. Okay, now coming to the consolidation part. As I told you, they are complicated. I'll simplify it. See, initially, what is the percentage acquired on 1st of April 23, 1st of October, 1st of April 22. Okay, so 1st of April 22, then 1st of October 22, and then 1st of Jan 23. Okay, so 1st of April 22, we need only 2 things. What is the percentage of acquisition and what is the profits of subsidiary? Maybe I just write it here so that I have some space. So 1/4/22, 1st of October 22, 1st of Jan 23. Okay, so how much is the, and maybe 31st of March. Okay, so how much is the profit of subsidiary? That you multiplied by the percentage of acquisition, you get the share of holding company in subsidiary company, the share of holding company. Now, percentage of acquisition wise, as I told you, it is not 25% of subsidiary company, it is 25% of 80%, 37.5% of 80%, 37.5% of 80%. So 25% of 80%, 25% of 80%, which is 20%. Then 37.5% of 80%. 30%. And again, same thing, 37.5% of 80%. That comes to 30%. And this is not we wanted. This is the acquisition made. But what is the cumulative one? This is 20. Now 20 was already there. So 20 plus 30. So this becomes 50%. Then 50 plus 30. So this is 80%. And 31st March and subsequently also you will have 80%. So these are the profit, these are the acquisition percentages. Now coming to the profits of subsidiary. As on 1st of April, it has a profit of 1,25,000. So as on this date, 1,25,000. Then for the year, they made a profit of 50,000. So 50,000 is full year profit accruing evenly throughout the year. I can calculate proportionate calculation. Up to 1st of October means I will select 6 months, and remaining from October to January 3 months, and Jan to March another 3 months. So dividing this ratio, first 6 months till October, then October to December, then Jan to March. So 50,000 into 6 by 12, you get 25,000. 25,000 into 50,000 into 3 by 12, you get 12,500, you get 12,500. So 25,000 they made profits. So 1,25,000 is on 1st of April. 1,25,000 plus 25. So 1,50,000 on 1st of October. 1,50,000 plus 12,500. 1,62,500 on 1st of Jan plus 12,500. 1,62,500 plus 12,500. 1,75,000. So 1,25,000 plus 50, 1,75,000. Now you got the percentage of the holding company. You got the profit of subsidiary, the profit multiplied by the percentage. So 1,20,000 into 20%, 1,25,000 into 20%, 25,000. 1,50,000 into 50%, 75,000. 1,65,000 into 80%, 1,30,000. Then 1,75,000 into 80%, 1,40,000. And that's what they've asked on different dates. So you can see we also got the same answer. 25,000, 25. Then we got 1,50,000. No, the percentage is 75,000. Got 75. Then 1,30,000, 1,30,000. We also did one more, which institute they have not done it. So that will give you the calculation for the percentage of holding company, the subsidiary company profits, multiply both, you will get the requirement of the problem. Okay, great. Let's go further. From the following details, calculate the value of goodwill. And on 31st March 22, they exhibit a profit of 1 lakh, general reserve of 60,000. This is just the goodwill calculation. So you can do it in my regular format, or I'll do quickly here itself. Goodwill is difference between whatever the purchase consideration, which means the investments, minus the share of net assets on the date of acquisition. Purchase consideration, investments, that is 7 lakh, minus share of net assets, that is the net assets of company on the date of acquisition, for which we take subsidiary company share capital and we take pre-acquisition reserves, that is on 31st March 22 on the date of acquisition. So 4 lakh plus 1 lakh plus 60,000. So basically 5,60,000 you get a share of net assets. So multiplied by the subsidiary companies, the so holding company share of percentage. How much share? 3,000 shares out of 4 lakh. 4 lakh by 100 means 4,000. So you can multiply it by 3,000 shares out of 4,000 shares. So share of net assets comes to 4 lakh share capital plus 1 lakh P&L plus 60,000. 5,60,000 share capital plus reserves is net assets on the date of acquisition, not on the balance sheet date, on the date of acquisition, multiplied by 3,000 by 4,000, 4,20,000 is the holding company's share of net assets. You have paid 7 lakh, so goodwill is 2,80,000. You can also do in my working note format, but if they're not as full-fledged problem, it's faster to do in this manner. So 2,80,000 should be the answer. Yeah, 2,80,000 is the value of goodwill. Okay, great. From the following summary bank account, prepare cash flow statement for the year ended. And they have given the summary of bank account. So it is only going to be direct method, not indirect method, because they have given summary of bank balance. And company does not have any opening cash and cash equivalent. So you know there are three kinds of cash flow activities. Cash flow from operating activities relating to regular course of business. Cash flow from investing activities, that is relating to the fixed assets investments, either purchase or sales. Cash flow from financing activities relating to loan obtained, loan repaid, shares issued, debentures redeemed, interest paid, dividend paid. Relating to liability side of balance sheet is financing. Relating to asset side of financing is investments, and relating to regular course of business, and that is operating. So let us clarify. Issue of equity shares, and that is financing activities, liability side of balance sheet. So equity share is financing activity. Receipt from customer, regular course of business, operating. Sale of fixed assets related to asset side, investing activities. Payment to supplier, ordinary course of business. Purchase of fixed assets, investing activity. Overhead expenses, ordinary business operating activity. Wages and salaries, ordinary. Income tax, ordinary. Dividend is financing activity. Bank loan is financing activity. And this opening balance, closing balance will come at the bottom of cash flow statement. So we have identified the category of cash flow statement. We simply have to put this in the proper group. So let's look at the solution. Cash flow from operating activities are receipts from customers, that is this 2,800. Then minus payment to supplier, overhead expenses, wages and salaries, income tax. So 4 payments are there. Minus cash paid to supplier, overhead expenses, wages and salaries, income tax. So what you get is 250 net cash flow from operating activities. Investing activities are purchase of fixed assets 200, a sale of fixed assets 100. Purchase means you keep it in minus, sale means you keep it in plus. So sale 100 is in positive terms, purchase 200 negative terms, net cash flow 100. Coming to financing, we have issue of shares 300, that is receiving. Payment of dividend and payment of bank loan. So 300 received, 50 paid, 300 paid. So total net balance of minus 50. 250 minus 100 minus 50, that comes to 100. That's called as net cash flow during the year. We add the opening balance is 50. So 100 plus 50, closing balance of 150 you will get. So this is regarding the cash flow statement. Okay, then the theory questions are there. I'll quickly run through it. I'll not spend much time. What are the 3 golden rules of accounting? Personal account, real account, nominal account. Personal account, debit the receiver, credit the giver. Real account, applicable for things and assets, basically property. Debit what comes in, credit what goes out. Real account. Nominal account, debit all expenses and losses, credit all incomes and gains. Then what is meant by extensible business reporting language, XBRL? How does it work? Now this is a format in which reports are submitted in machine readable form, not a human readable form. So XBRL is a specific language of format, or you can say a software, a mode in which the financial data and non-financial data is fed into, submitted to MCA using a separate framework. It has something like taxonomy, so that the data can be processed faster because it is in a machine readable format. More theory is there, you can read it. You have like taxonomy, tagging being done, you see taxonomy, regulatory requirement, mapping being done, so that different industries, different companies can submit in a common platform in a machine readable format, so the data can be processed and it can be compiled and analyzed in a faster manner. Then coming to what is the convergence of accounting standard of with IFRS in India. India has the Indian GAAP. GAAP means generally accepted accounting standards, accounting principles. Just like Indian GAAP, different countries have their own GAAP, like US GAAP, UK GAAP, and so on. So especially when you talk about multinational companies who have presence in different countries, where different countries follow different accounting standards, there was duplication of activities where companies have to redraft the financial statements to suit their local accounting standard purpose. To minimize this duplication, to minimize this difference, to harmonize the accounting standards, India has come up with a roadmap called as Indian Accounting Standard Ind AS, which is almost same as IFRS. So the need for conversion comes from the fact that the company should follow uniform financial statements, reduce duplication, and faster financial statement preparation. So single set of accounting standard, international capital to move more freely because you can prepare the fast statements more comfortable manner, beneficial for regulator, for investor gives a better understanding, and beneficial for the accounting profession because you don't have to keep preparing the accounts under multiple accounting framework. Okay, so this is regarding accounting part. Yes, question number 4 is done. This is regarding the accounting part. Now starts the financial management. Any other questions so far? Great. Coming to financial management. Financial management, we don't have any complicated questions, so we should not take much time. We have questions, we have answer. Let's try to run through that. Question number 5, let's read. XYZ is a company standardizes chandeliers a segment. The deal is more or less okay. I don't want to read the theory. On 1st of April, the board of directors of company is desired to knowing about a working capital. Oh, question is regarding working capital. The moment you say working capital, what should come to your mind? The format should come to your mind. The first one heading should be current assets minus current liabilities. Current assets means inventory of raw materials, work in progress, finished goods, then debtors. Minus liability means creditors for raw materials, creditor for wages, creditors for overheads. The format should come to your mind, and when the format is ready in your mind, you can read the question and you can connect it faster. The following details have been provided on beginning of the year, 1st of April. Share capital, debentures, fixed assets. Production and sales during the year 23-24 is expected to average 500 units per month. 500 units per month. So 500 into 12, 6,000 units per annum. The cost to selling price are likely to be as follows: 60% raw materials, wages 10%, over at 20%. Cost to selling price. Where is selling price? Somewhere later they have given 5,000. So let me calculate 60% of 5,000, which is 3,000. 10% of 5,000, which is 500. 20% of 5,000, which is 1,000. So total cost is 4,500, which means selling price 5,000. If you are maintaining 4,500 cost, the balance 500. 5,000 minus 4,500, balance 500 is your profit. Profit margin also you have to keep, right? Then raw materials and components are expected to remain in the store on average period of for 2 months. Please observe this question carefully. Institutes are very clever in giving the question like this. They'll give the data of number in words. See, 2 months. They could have given number 2 like this, but they're given TWO. So in examination condition, operation theater, people miss out on reading this data point. So whenever the data like this, either you underline or you write in your answer paper somewhere so that you don't remember, you don't forget it. So 2 months of raw materials. So how do you calculate raw materials? 6,000 raw material cost is 3,000 rupees. Number of units is 6,000. So 6,000 units multiplied by 3,000 and 2 months is the stock. So annual consumption is 6,000 units into 3,000 rupees. Annual consumption of raw material 6,000 units into 3,000 rupees. Number of units into cost per raw material. Then 2 months, so 2 by 12. Each unit is product to be expected to be in the process for 15 days. Work in progress cost 100%, material 50% and overheads. And assume 360 days or 52 weeks. So how do you calculate the work in progress then? The material cost is 100%. So you will have 6,000 units multiplied by 3,000 rupees multiplied by raw material 100%. Okay, plus 6,000 units multiplied by wages. Wages is 500. So into 500 multiplied by 50%. Then 6,000 into 1,000. This is also 50%. This will give you total cost, and this you multiplied by 15 months, 15 by 360. Material cost plus labor cost plus overhead cost, total multiplied by the holding period, 15 by 360. Material 100%, I multiplied by 100%. Labor and overhead 50%, so I multiplied by 50%. Finished goods in the stay or warehouse for 1 month. So finished goods directly I can take 4,500 rupees, or you can do breakup also, it's fine. So 4,500 rupees multiplied by 6,000 units for 1 month, so into 1 by 12. Supplies of raw material extends 1.5 months of credit. This will be for creditors calculation. So again 3,000 rupee raw material into 6,000 units multiplied by 1.5 by 12 gives you creditor. 80% of the sales are on credit. So you are selling at what price? You are selling at 5,000 rupees. You are selling 6,000 units. So 6,000 units, 80% are on credit. What is on cash will not come for debtor calculation. So 80% for credit, only 80% you multiply. So 6,000 into 80% is number of units sold on credit basis multiplied by selling price. Selling price is 5,000 multiplied by the credit period given. Credit period given is 2 months, but average collection is 75 days. You are giving 2 months. They are taking 75 days. You are giving is not important. How much time they take is important. So this you multiplied by 75 by 360. Then overheads are 2 weeks remaining outstanding. Overheads means this 1,000 rupees. So 6,000 units multiplied by 1,000 rupees, annual overheads multiplied by 2 by 52 overheads. We apply for wages also same thing if nothing is given. 1 year is equal to 365 days. Debtors to be valued on cash cost. Oh, debtors to be valued at cash cost, not on selling price. That means I should not multiply it by 5,000. 5,000 means including profit. I should multiply it by this 4,500 rupees. Debtors are valued on cash cost basis. Okay. Then after the 10% to be calculated for contingencies. Okay. So if I look at the institute solution, okay, coming to the current assets, raw metal 6,000 units, 3,000 rupees I told you, right? 5,000 rupees multiplied by 60%. That's what 3,000 rupee per unit. And 2 months is credit period. Work in progress, 3,000 rupees. I told you this 500 rupees into 50% because 50% complete, and this is 1,000 rupees into 50% complete, so 500 rupees. And how 500 rupees and 1,000 rupees comes? That is the percentage, this percentage, right? The 10% of 5,000 and 20% of 5,000 of selling price. That is what is per unit cost. Then finished goods, that is anyway straightforward, no 50%. So 3,500 and 1,000 into 6,000 and 1 month credit period. Now coming to debtors holding period, 6,000 into 80% because only what is sold on credit basis should be taken. Then 3,000 plus 500 plus 1,000, that is cost of goods sold per unit, and multiplied by 75 days will give you amount of debtors. So that is your current assets. Creditors also have explained 6,000 units into 3,000 rupees, 1.5 months. Overheads 6,000 units. Okay, wages is not considered, only overheads they said. 6,000 units into 1,000 rupees into 2 by 52, 2 weeks delay in payment of wages. So current assets minus current liabilities, you get the working capital, and whatever working capital 10% contingency is added, that will give you the estimated working capital. Before we go to P&L account, do you have any doubts in any of these calculations? Finished goods calculation part. Okay. Finished goods calculation. Finished goods is comprised of cost per unit. See, okay. Let me show the calculation here. See, as I showed calculation here, the 60% of selling price of 5,000 rupees. So this is 3,000. 10% of 5,000 is 500. 20% of 5,000 is 1,000. So total cost is 4,500. Okay, so number of units into cost into holding period. That is a general formula, I remember. Okay, units multiplied by cost multiplied by the period. This is the formula we use for all the calculations. Units are 6,000. The cost of finished goods here 4,500. And the finished goods are in warehouse for 1 month. So into 1 by 12. 6,000 into 4,500 into 1 by 12. So you get 22,50,000. That's what 22,50,000. Hope you are able to get the finished goods calculation part. Now coming to the second part of the calculation, prepare a P&L account. Anyway, you already know cost now, right? 3,000 is the material, wages is 500, overhead is 1,000 and selling price is 5,000. So all this multiplied by 6,000. So 3,000 rupees into 6,000 give you material cost. 500 rupees into 6,000 gives you wages cost. Then 1,000 into 6,000 will give you overheads cost. And 5,000 rupees selling price into 6,000 will give you the sales. So you can prepare the P&L accounts. So take a look at the P&L. As I just told you, 6,000 units into 5,000 rupees is 3 crores. Materials 6,000 units multiplied by 3,000 rupees. Labor 6,000 into 500. 6,000 into 500 is labor. 6,000 units into 1,000 is overheads. So we got material, labor, overheads, gross profit balancing figure, or you can also do 6,000 into 500 rupees, because out of 5,000, 4,500 rupees was cost, remaining 500. Then you pay debenture interest, debenture 50 lakh, 10% interest, 50 lakh into 10%, 50 lakh into 10%, so 5 lakh, remaining profit is 25 lakh. So simplest P&L account you can get. Balance sheet, fixed assets is same 1.25 crore, that is 1 crore 25 lakh. Actually during the year there should have been depreciation, no information depreciation. So they have given the amount as it is. Otherwise, if their information depreciation would be there, that depreciation comes in P&L and that money you will subtract and write the balance amount in the balance sheet. And one more point, this being financial management, even though it is a balance sheet of a company, you need not write in Schedule 3 format. Only if it is Part 1, corporate accounting, there a balance sheet of a company should be in Schedule 3 format. Otherwise, it can be regular balance sheet, assets, liabilities, sufficient. Non-current assets, what we calculated? Working capital, 30 lakh, 9 lakh 37, 22 lakh 50, 45. 30 lakh, 9 lakh 37, 20 lakh 50. Debtors is not 45 lakh, debtor is 50 lakh. Because debtors here we calculate on cash cost basis, but it should be calculated on in the balance sheet, not on cost basis, full value basis. So 6,000 into 80%. We don't do 4,500 for debtors at cash cost, we take it at cost. But for balance sheet purpose, you multiply it by selling price. So 6,000 into 80%, don't take 4,500, you take selling price of 5,000 into 75 by 360 goes. So 6,000, 80% into 5,000 into 75 by 360. You get 50 lakhs. That was 50 lakhs. Debtors. Current assets is balancing figure actually, because debenture 50 lakh is there. Profit we made 25 lakh. This comes to the liability side. Share capital 2 crore they have given. Creditors we have done that part of working capital. Wages we have done for working capital. So this cash and bank is a balancing figure. So you prepare the balance sheet as a balancing figure. That money will come as cash and bank balance. Okay, so this is regarding question number 5. Let me know if you have any doubts in question number 5. Okay, great. Question number 6. ABC Limited provides the following information regarding the cost of a product: materials 20, wages 16, variable factory overheads 25% of variable administration overhead, 10% of factory cost. Then variable selling distribution is 4 per unit, fixed overhead is 8,000. From the above data, you are required to calculate the profit volume ratio, break even point, margin of safety, and profit. Okay, so we need to know what is the selling price and what is the variable cost, and that will give you contribution. Minus fixed cost, selling price minus variable cost is contribution, minus fixed cost is profit. That is a basic structure you should know. Selling price minus variable cost is contribution, minus fixed cost is profit. Selling price sold at 64 per unit, 1000 into 64, 8000 units sold. 1000 units sold at 64 per unit. So 64 into 1000, 64,000. Okay, 6,000 into 64, 64,000 minus variable cost. What and all variable cost? Material 20, then wages 16, variable overheads is 25% of wages. So variable overheads 25% of wages. So 16,000 25% is 4,000. 16,000 25% is 4,000. Administration overhead 10% of factory cost. Oh, 10% of factory cost. You need the factory cost. Then factory cost is the sum of these three: material plus wages plus variable overheads, and that is called as factory cost. So 20 plus 16 plus 4 is 40,000. Then factory overheads of this 10%. So 4,000, 40,000, 10%, 4,000. Then selling and distribution overhead 4 per unit, 4 into 1000. So selling and distribution overhead 4,000. So you get total 48,000. So selling price 64, variable cost is 48. So contribution you get is I think 16,000. Fixed cost is given, fixed overhead 8,000. So minus 8,000, you get profit of 8,000. Profit volume ratio, that is nothing but gross profit, you can say approximately. Contribution by sales into 100. Contribution is 16,000. Sales is 64,000. Let me show the institute solution. Contribution is 16,000 by sales is 64. 16 by 64, 25%. Then break even point. Break even point is the fixed cost divided by profit volume ratio. Fixed cost is 8,000 divided by PV ratio 25%, 8,000 25%, 32,000. Margin of safety. Margin of safety is sales minus break even point. So sales minus break even point. Sales is 64,000. Break even point we got as 32. Yeah, 64 minus 32, 32. Profit, anyway, already calculate the profit, last one. Contribution minus fixed cost, profit is 8,000. So question number 6 also is done. Oh, 6A is done, sorry. Okay, next onwards I'll go a little faster because these are all straightforward questions. Question B, equipment A costs 75,000, net cash flow 20,000 per year for 6 years. Substitute the equipment B cost 50,000 and generate cash flow of 14,000. Required rate of return is 11%. Calculate net present value and profitability index. So NPV is the present value of inflows minus investments. So net present value can be calculated as annual cash flow into annuity factor, and they have given a discounting factor for each year. Add all, you get annuity factor. So cash flow of 20,000 into annuity factor, if you add all, you get 4.231. So this will give you present value of inflows minus investments, 9620. Similarly, you do for equipment B. Present cash flow is 14,000, annuity factor 4.231 minus investment of 50, 59 minus 50,000, NPV of 9,234. Profitability index is present value of inflows divided by investments. So 84,620 by 75, 59,234 by 50. If you subtract, you get NPV. Present value of inflows minus investments, that is NPV. Then present value of inflows divided by investments, and that is profitability index. Now, if you ask me which one to choose, NPV wise 9230, equipment B is higher, and profitability index wise equipment A 1.128 is higher. So if you have to choose one between mutually exclusive projects, I'll go with equipment B. But if you have total money to buy both, then I'll go for I can go for both of them. But in the question they said it's a substitution, right? Meaning either you have to choose A or B. I would go with equipment B, considering that NPV is higher. Sorry, not equipment, equipment A. 1.128, 1.185. So as far as NPV is concerned, equipment A is better. As far as profitability index is concerned, equipment B is better. But when there is a conflict and between mutually exclusive decisions, only one of them you have to select, I'll go with equipment A, being NPV is higher. That's what you do. Whenever there is a conflict, we go with absolute profit. Absolute profit is NPV. And that is part B of the question. Part C. From the following an extract of financial statements, operating profit, interest, income tax, profit, market price, what you have to calculate? Calculate EPS. EPS, net profit divided by number of shares. Net profit, this is rupees in thousands, 50.4 divided by number of shares. Where is number of shares? 200 divided by 10, 20, that is 1000. 50.4 divided by 20. 50.4 divided by 20, EPS, earnings per share, is profit after tax divided by number of shares. Profit after tax means net profit, number of shares, 200 is rupees, divided by 10, so you get 20,000. Then calculate EPS. EPS we have done. Cost of capital to the company for debentures and equity. For equity calculation, cost of equity, I need dividends. D1 by P0 plus G. I don't have dividends. I don't have growth rate also. So when dividends are not given, we'll follow earning based approach. Earning based approach means whatever is your earnings assumed to be dividends, means dividend per share is equal to earning per share. Now just now we calculate earnings per share 2.52. So earnings per share divided by market price per share, that becomes cost of equity. So earnings per share we calculated 2.52. Then market price per share is given as 12. So 2.52 divided by 12, cost of equity you will get as 21%. Cost of debentures. Cost of debentures can be calculated either based on market value or based on book value, but typically I would go with market price, so I'll go based on that. Debenture market price, the formula what we're going to do is whatever the debenture interest divided by net proceeds. Net proceeds means market price. Debentures market price is 93.75. Debenture interest, 15% convertible debentures, okay, into 1 minus interest. Okay, I should do like this. Cost of debenture is whatever debenture interest into 1 minus T divided by market price, net proceeds. Debenture is face value 100 each, 220. Market price debenture is 93.75. So what will be per cost by unit basis tax rate they have given, tax rate also given. So interest 15% on 100 rupees. So 15 on 100 is 15. 1 minus tax rate, 1 minus 0.3 divided by market price. Market price is 93.75. Then you can multiply it by 100. So 15 rupees into 0.7 by 93.75 into 100, you get 11.2%. Yeah, that's what institute also got, 11.2%. Yeah, interest into 1 minus t divided by market price. Okay, then point D. RST Limited has a capital of 10 lakh in shares of 10 each. The shares are currently quoted at par. Company also proposing to declare a dividend of 10 per share at the end of current year. The capitalization rate for the company is 12%. You're required to calculate market price of the share if dividend is declared. If dividend is not declared, and we have to use model. Okay, model, again you have to remember the formula. If dividend is not declared, the formula is P1 plus D1, that is basically value at the end of first year, divided by 1 plus KE. We use it for both the cases. Dividend not declared, that means dividend is 0 divided by 1 plus KE. KE is 12%. So 1 plus 0.12 equals to current market price. Current market price is 100. So cross multiply, P1 100 into 1.12 is 112. So dividend is not declared, 112. If dividend is declared of 10 rupees, basically 10 rupee will be less. P1 plus 10 rupees divided by 1 plus 0.12 equals to 100. So P1 equals 112 minus 10, you get it as 102. So 112 and 102. Let me check the answer. Yeah, 112 and 102. And assuming the company pay dividend and net profits of 5 lakh and make new investments of 10 lakh, how much shares to be issued? How much shares to be issued depends on how much money is required. So how much earnings of the company is 10 lakhs minus dividend. They pay dividend of 10 rupee per share. 10 rupee with 10 lakh of 100 each. So if you divide by 100, I think you get 10,000. So 10 rupee into 10,000. So dividend of 1 lakh. So in 10 lakh rupees, 1 lakh you pay as dividends. Not 10 lakh. You have a profit of 5 lakh. So in 5 lakh, if you pay a profit of dividend of 1 lakh, balance is 4 lakh. But investment is required 10 lakh. So what is the shortage? So amount raised by equity, you will receive 10 lakh minus you have 4 lakh already. You need 10 lakh. So balance 6 lakh. How many shares? 6 lakh divided by number of shares to calculate, divided by market price. So 6 lakh divided by 102, 5,882. 6 lakh divided by 102. Amount required by issue of shares divided by issue price. Okay, so that is regarding sixth question. Sixth question on one part of the question. Then you have a choice. I think that would complete the paper. That is clear. So we'll be able to finish it off quickly. Any other question on the, so far on dividend calculation or cost of equity, cost dividend calculation, cost of debentures calculation? Okay, great. So let me just finish off this part. What do you mean by Aron indicator? Is one of the technical indicator in stock market. It gives you idea when to buy, when to sell. You write this question for any technical indicator question you get in the exam. It is a technical indicator. Technical indicators are used for identifying the trends, which will help to take position in short-term movement. The same Arun indicator, it basically trying to calculate for last 25 days what is the trend, upward trend or downward trend. So Arun indicator will give you 25 minus previous high or 25 minus previous low. That's what is Arun indicator. So indicator is a technical indicator. It provides the strengths on the trend part. So Arun up means the measure is on upside. Arun down means it will measure upside and downsides. And if you want, you can write the formula. I don't want to go much into it. Then regarding Hamda equation is basically, in CAPM model, we calculate something called as beta representing risk. So risk of a company comes from two cases. One, operating risk, the company's operations, and financial risk, whether company takes loan or not. So when you want to convert from levered beta to unlevered beta or vice versa, meaning if company had not taken debt, what risk the company has? Purely operating risk, that is unlevered beta, operating risk. And if company takes debt, that means financial risk is also coming, that becomes levered beta, and that formula which converts between levered to unlevered is given by Hamda equation. So levered beta equals unlevered beta into 1 plus debt by equity into 1 minus T. Logically you understand. Unlevered beta comes from operation risk. Then company has debt, so debt by equity ratio and after tax into 1 minus T. So you have a debt equity ratio of 0.65. So debt by equity is 0.65. Tax rate is 35%, 1 minus 0.35, and unlevered beta of 0.8. So unlevered beta means before taking any debt, before financial risk. And if you have debt, your risk will increase. You see 0.8 has increased to 1.138. As a result of taking more debt, company's risk, that is beta representing risk, company risk is increased, attributable towards financial aspects. Then difference between annuity due and annuity amity. Annuity, regular, annuity ordinary means the payments are made at the end of every period. Annuity due, or also called annuity immediate, means payments are made at the beginning of each period. So when payments are made at the beginning, the present value of annuity will be higher. Annuity at the end, the present value will be lower. Briefly explain emerging roles of financial manager. This theory, in current day world, a financial manager should look at the larger aspects of company strategies, liquidity position, growth aspects of the company, balance between the we will say the growth and sustainability. So the finance manager is responsible for strategic balances, financial balances, liquidity balances, and so on. So that theory you can write. What are the responsibilities of current day financial managers? I hope the time what you have spent was worth it. I have not discussed in detail each and every question, but I hope the discussion what we had is useful. Do you have any other doubt before we conclude the session? Okay, great. No other questions are coming in. If you have any doubts, you can either contact to, you can get in touch with the Ekcel Academy official numbers, or you can WhatsApp them and they will be able to help you out, and they'll also take my help in answering your doubts. I hope this session was useful. Please prepare for exams and write well. Always remember, control the controllables. Exam results is not in your hand. The preparations are on your hand. Don't worry about the results. Focus on your efforts. All the best. Do well. See you soon. Take care. Bye bye.